Good afternoon, everyone. We'll just give everyone just another minute or so just to log in for those who are wanting to join us. We'll get started very shortly. So once again, good afternoon. Thank you for joining me for the Superannuation quarterly update. My name is Alexandra Plum and I'm a manager in the Superannuation advisory team here at Vincent's. Just a quick message to say that the information shared here today is of a factual and general in nature and doesn't consider your personal financial goals or objectives. So today we're going to cover off on a few different topics. A number of these issues have just taken effect in the last couple of months. So firstly, we'll cover off on some key lodgement dates and deadlines, then move on to non-arm's length expenses, have a look at some COVID relief that's continuing into the current financial year, then a few bits and pieces, some news and alerts in the superannuation space, and finally we'll cover off on some new ATO lodgement policies that have come into effect. So firstly, let's have a look at some key lodgement dates and payment deadlines that are coming up. If you joined me for the last quarterly webinar, I did cover off on a few of these upcoming due dates, but I don't think it hurts to have a quick reminder, especially as a couple of them are this week. So firstly, this Thursday, the 28th of October, is the due date for employers to make payment of super guarantee for the September 2021 quarter. It's also the due date for the lodgement of the September 2021 quarterly TBAR, so that's Transfer Balance Account Report. Now, just a reminder, this is only applicable for self-managed super funds that are required to lodge on a quarterly basis. So that's you've got at least one member in the fund that has a total superannuation balance in excess of $1 million. So then this weekend on the 31st of October, the 2021 annual returns are due for any funds that have prior year outstanding tax returns. So that's the prior years and the 2021 year all due by the 31st of October. So then on the 25th of the next month, all September 2021 quarterly activity statements are going to be due for lodgement and payment. Now, this date is only applicable when the activity statement is prepared and lodged by a tax agent or a registered BAS agent. For activity statements that are not prepared by a tax or a BAS agent, they're actually going to be due on Thursday on the 28th of October. And then lastly, jumping ahead into 2022, I realise it seems a long way away, but it's probably not. But on the 28th of February, 2021 annual returns are due for self-managed funds that were newly established in the 2021 financial year. So the first topic I'd like to cover off on is a recent update regarding non-arm's length transactions. The ATO has released Law Companion Ruling 2021/2 back in June of this year to update an original draft ruling that was released back in 2019. The final version of this ruling addresses the very much debated issue of when transactions between an SMSF and another party are potentially creating a non-arm's length issue. So specifically, we're looking at non-arm's length expenses, and these exist when we've got expenses that have been incurred by a self-managed fund and they're less than the amount that would have been incurred had the self-managed fund been dealing with another party on an arm's length basis. So if we've got a fund that is deemed to have these non-arm's length transactions, then what's going to happen is that the associated net income in the fund is going to be taxed at the top marginal rate of 45%. So quite a contrast to the concessional rate that most super funds enjoy of the 15%. Now, this final ruling divides non-arm's length expenses into two different categories. The first one being expenses that relate specifically to an individual asset, and the other one is the general expenses, and they don't relate to a specific asset of the fund. So going back to the first category, the costs that specifically relate to an individual asset. So a really good example of this type of cost is the interest expense arising from a borrowing arrangement that's associated with a property owned by the super fund. The interest expense would be considered a non-arm's length expense if that interest rate on that borrowing arrangement was well below what the market rate normally is. So for example, if we had a loan and it was interest free, that would definitely not be arm's length. So in this scenario, the interest expense can be specifically attributed to the property that's owned by the fund. And that's why it's falling within this first category. So for these types of expenses, once it's been established that it falls into this category and that that expense has been incurred not on an arm's length basis, then all future income earned by the super fund in relation to that asset is forever going to be tainted and treated as non-arm's length income. So it's going to be taxed at that 45% penalty rate every year for as long as the fund owns that asset and is incurring income from that asset. It even goes so far as to include any capital gains. So if the fund goes and sells that asset and it's been tainted as non-arm's length, then any capital gains associated with the sale of that asset are also going to incur that 45% tax rate. So then moving on to that second category of non-arm's length expenses, the general costs, which don't relate to an individual asset. A really good example of general costs of the fund would be the annual accounting and audit fees that are incurred for the preparation of the fund's accounts. If the fund received a discount or it received its accounting services for free, then these expenses might be considered non-arm's length. So in cases where general expenses are considered non-arm's length, then this new ruling is actually going to deem that all income of the fund will become non-arm's length income, so taxed at that 45% rate. So this is not just the income coming from a particular asset. Because we can't attribute general expenses to one asset, then the ATO have said all income from the fund is going to be taxed at that higher rate. Now, in contrast to the consequences for costs relating to a specific asset, this new ruling actually outlines that general costs are only going to give rise to non-arm's length income in the particular year in which they are charged on a non-arm's length basis. So in practical terms, this means that undercharging accounting fees in 1 year is only going to impact the tax treatment of the income for the fund for that 1 year. If in the next year the accounting fees were back to being charged on an arm's length basis, then that higher tax rate is not going to apply in that next year. So this ruling will be applied retrospectively, and it took effect from 1 July 2018. However, the ATO have come out and said that they're not going to apply any compliance resources to any potential non-arm's length transactions that have occurred before 1 July 2022. So basically, in the next financial year to the current one we're in, we do need to make sure that we are that we've got all transactions in the fund occurring on an arm's length basis, so we're not getting hit with this higher tax rate. I think there's still a lot to decipher from this new ruling, and more questions are going to come to the surface from practitioners in the industry as we're going to get more real life examples. So moving on to having a talk about relief that super funds have been extended as a result of the impacts of COVID. So in September, the ATO has announced an extension to the COVID-19 relief that was offered back in the 2020 and the 2021 financial years. Now, they've said that these relief measures are going to further extend forward into the 2022, so the current financial year. Now, there are 4 relief measures that are available to self-managed super funds. Firstly is residency relief, then we've got rental relief, loan repayment relief, and in-house asset relief. Now, just to refresh everyone's memories on what each of these relief options are about, or perhaps if you've never used them before and they're now available to be used. So firstly, the SMSF residency rules require an Australian super fund to meet 3 residency conditions. The first one, the fund needs to be established in Australia or have at least one asset that's located in Australia. Secondly, the central management and control of the fund needs to be based in Australia. And finally, the fund needs to have either no active members, and an active member is someone who is making contributions or rollovers to the self-managed fund. So no active members, or if the fund does have active members, then those members need to be Australian residents and hold at least 50% of the total value of the fund. Now, where this relief comes into play is around condition 2 regarding the central management and control of the fund. And we're finding that this condition might have been breached where a self-managed super fund trustee has been stranded overseas because of COVID. Now, normally, when we've had a breach of this condition, the self-managed fund would lose its residency status and would no longer be considered an Australian super fund for tax purposes. Now, losing your residency status means that the fund is no longer going to be entitled to receive tax concessions. So it's a pretty big penalty. Now, provided there are no other changes in the SMSF or the trustee's residency circumstances, the ATO is going to continue to not apply any compliance resources to determine whether a fund has met its residency test. So moving on to rental relief. If relief has been provided by a self-managed fund to its tenant in the form of a reduction, a waiver, or a deferral of rent, then this normally gives rise to a contravention of the super laws. But as part of the ATO's rental relief measures, no compliance action will be taken against an SMSF on the proviso that the relief has been offered on commercial terms due to the financial impact of COVID, and that the self-managed fund has properly documented that arrangement. Now, the ATO also plans to make a determination for the current financial year, which is going to ensure that a rental deferral offered by a self-managed fund to a related party tenant does not cause that deferred rent to be treated as an in-house asset in current and future financial years. Now, the third relief measure is loan repayment relief. The ATO will not take any compliance action against self-managed funds that provide repayment relief to parties that have borrowed monies from the fund, and whether those parties are related or unrelated, it doesn't matter. And those parties have subsequently experienced financial hardship due to the impacts of COVID. So it's very important that the repayment relief is again offered on commercial terms, and that any changes to the loan agreement is properly documented. Similarly, if an SMSF has a limited recourse borrowing arrangement with a related party, and the lenders have offered loan repayment relief to the super fund due to the impacts of COVID, then the ATO is willing to accept that the parties are dealing with each other on an arm's length basis, again, as long as the relief offered is on a commercial term and that the SMSF has properly documented. So this is going to make sure that self-managed funds are not falling into that non-arm's length expense trap, which I just spoke about, as a result of impacts from COVID. So the final relief measure is in relation to in-house assets. So in-house assets are defined as loans to or an investment in a related party of the super fund, or it could be an investment in a related trust of the fund, or it could be an asset that is leased to a related party. Now, there are some specific exemptions to these rules. However, if the fund is deemed to own assets that fall within the definition of an in-house asset, then the market value of those particular assets must be less than 5% of the fund's total assets each financial year. So where we've got an SMSF that's exceeded the 5% threshold at the end of a financial year, then it needs to prepare and execute a written plan of how it's going to reduce the value of those in-house assets to be below the 5% by the end of the preceding financial year. Now, the relief being offered by the ATO is that they're not going to take any compliance action against self-managed funds where the trustees have prepared the plan, but they haven't been able to execute it by 30 June 2022 as a result of market impacts from COVID. So change of gear now, just going to have a look at a few different updates and changes that are going to be coming in either in the last couple of months or in the next month. So firstly, just have a look at the changes around stapled funds. So for a few years now, if an employee did not choose a superannuation fund, an employer has been required to make the super contributions for that employee into the employer's chosen default fund. Now, this process has resulted in lots of Australians having multiple superannuation accounts. But from next month, this is going to change, or next week actually, this is going to change with the implementation of the stapled super fund rules. This change is intended to make sure an individual's existing super account is linked or stapled to them so that the account will follow them around as they change jobs. This stapling is going to prevent the creation of unintended multiple superannuation accounts, and in turn it's also going to reduce the fees that would otherwise have to be paid on having all of those accounts as well. Now, these new rules will apply for any employee that starts a new job on or after the 1st of November 2021, and they already have a stapled fund, plus they haven't already nominated a particular fund to receive contributions. It's also important to note that employers can continue to make contributions to their preferred default fund, but they can only do this where the employee has not already chosen a fund to receive contributions, and the ATO has also notified the employer that the employee doesn't have an existing stapled fund. Employers will be able to find out whether their new employees have an existing stapled fund, and they can do this by submitting a request to the ATO via the online services platform. Now, as always, there are penalties that are going to be applied to any employers who are choosing not to follow these new rules. So from 1 October, self-managed super funds are going to start needing to use SuperStream to roll over any super fund benefits. So this change is going to impact self-managed funds, with members wanting to roll over money into their self-managed fund, roll over money out of their self-managed fund, but also receive and action certain release authorities. So this would include when you elect for your super fund to pay Division 293 tax, or if you need to release excess contributions from your fund. Now, the ATO intends for this change to make the processing of rollovers fast, efficient, and a lot more secure for both members of self-managed funds, but also large APRA funds as well. And additionally, this change is going to see administrative processes for rollovers and release authorities being aligned for both the self-managed funds and the large APRA funds too. So individuals are going to have a couple of options available to them when they want to initiate a rollover request. Firstly, you can do it via your MyGov account if you have one. Secondly, you could do it by completing an ATO rollover request paper form, so that's a little bit old school, or you can contact your transferring or receiving super fund directly. Similarly, if you want to, individuals wanting to initiate a release authority process, options available to do that is, again, they can do it via their MyGov account, or they can complete an ATO election to release from super form. So what we're going to see, instead of the applicable super fund receiving an ATO release authority, which normally that has come via the post in paper format, or the members needing to prepare and sign a paper rollover benefit statement, the fund is now going to receive an automated message via the SuperStream system requesting that whatever the applicable action is, it takes place. These new rules also now require trustees to action rollover requests from members as soon as practicable. And what the rules are outlining is it actually needs to be done within 3 business days. Now, this 3-day rule is going to apply to both self-managed funds and the large APRA funds. And it's going to be quite a contrast because previously super funds had a turnaround time of up to 30 days to process rollovers. So it's very, very fast with these new rules. The new rollover process will also require self-managed fund trustees to verify the requesting member's identity and keep documentation to confirm that this verification process has taken place. This requirement will align with existing identity verification processes that large APRA funds are already doing, so falls into that bracket of aligning self-managed funds and large APRA funds in how they process rollovers. Now, if you haven't worked it out already, the biggest challenge for many self-managed super fund trustees will be ensuring that the fund's accounts are kept up to date on a regular basis in order to meet these really fast turnaround times. This is quite a contrast to previous practices whereby transactions were really only reviewed and reconciled on an annual basis. So for self-managed super funds in particular, I think it's going to be important for fund administrators and accountants to work really closely with the trustees of the fund to ensure that the correct information is shared and that payments are going to be made within the required timeframes. So having a look now at some changes to the actuarial requirements. So Parliament has passed another bill in September, making some very much needed changes to the actuarial requirements for super funds. The new law removes a requirement for superannuation trustees to obtain an actuarial certificate when they calculate how much of the fund's income will be exempt from tax. And the need to do this is where all members of the fund are in full retirement phase for the whole financial year. The law is going to apply from the 2022, so the current financial year, and into future financial years. Now, just as a refresher around actuarial requirements, super funds need to obtain an actuarial certificate in a particular financial year when a portion of the fund is in pension phase and the remainder is still in accumulation phase. So accumulation phase being it's still in receipt of contributions from members. Funds might also need to obtain an actuarial certificate where there are certain types of pensions running in the fund. So, for example, certain types of defined benefit pensions, like a lifetime complying pension, require an actuarial certificate to be obtained, even if the fund's in full retirement phase. So prior to the introduction of this new law, funds with pensions were required to obtain an actuarial certificate even when all the members were in that full retirement phase for the whole financial year. So that means there were only pension accounts running, no accumulation accounts. So we automatically know that when we're in pension phase, that any income earned and associated with that pension is exempt from tax. So if the whole fund is in pension phase, then it's safe to assume all income is exempt from tax. Now, the new law is going to firstly reduce costs and also remove unnecessary red tape for affected funds, because we don't need to pay an actuary to give us a certificate to tell us that the fund is in full pension phase and therefore all income is exempt. It's also going to allow these funds to use the segregated method to calculate how much of the fund's income will be exempt from tax each year. So very good news. Now on to some new change around director identification numbers. So as part of an initiative to modernise Australia's business registries, all directors of Australian companies will be required to apply for a director identification number. It is a unique identifier that a director will apply for once and they're going to keep it forever. So this means, in the case of the super space, if you are a director of a corporate trustee for a self-managed super fund, then you're going to need to apply for one of these director IDs. Now, the introduction of director IDs is designed to help stamp out illegal phoenixing and other fraudulent activity. It's also going to enable the government to verify and track the corporate history of individual directors. So you will be able to apply for a director ID from November 2021, and you can do this on the Australian Business Registry Services website. The application process and future access to this online service is all going to be done using the MyGov ID app. And there's also going to be no cost associated with the application for a director ID, which is good news. So if you are a director, when do you need to apply for your ID? And it all depends on the date that you became the director. So if we have a look on the slide here, if you became a director on or before the 31st of October 2021, then you need to apply for your ID by the 30th of November next year. If you become a director, and this is for the first time, between the 1st of November and this year and the 4th of April next year, then you need to apply for your ID within 28 days of being appointed as a director. And then finally, if you become a director from the 5th of April next year onwards, then you need to apply for your ID prior to being appointed a director of that company. So what's very, very important here is that all directors are going to need to apply for their own ID. So no one else can apply for it on your behalf. Now, what I'm getting at here is that quite often, as the accountant or the tax agent, we would assist clients with a lot of ASIC-related obligations. In this instance, we're not able to help directors apply for the ID. And the reason for this is because the application process involves you needing to verify your own identity. Obviously, that's not something that we can help with. Now, if you don't meet your new directorial obligations, there may be civil or criminal penalties, and you also might be issued with an infringement notice. So it is important to make sure that you are applying for your ID within those timeframes, so that we're not getting any of those penalties. So I'd just like to finish up on the topic of outstanding lodgements and how the ATO are encouraging taxpayers to get their lodgements up to date. So outstanding lodgements are a very real issue currently facing a lot of SMSF trustees. And if a self-managed fund income tax return is overdue by more than 2 weeks and a lodgement deferral request hasn't been submitted with the ATO, then the fund status is actually going to be updated on the Superfund Lookup website to be changed to regulation details removed. Now, this status will remain in place until all of the outstanding tax returns have been lodged. So why is this change of status such a big deal? Firstly, if we have this regulation details removed status, the SMSF can't receive any contributions. So that's quite a big deal. If you've got your employer paying your 10% into your super fund, they actually won't be able to do that anymore. Secondly, members won't be able to make any rollovers to another super fund. They'll be prevented from doing that. And also the self-managed fund won't be able to accept any rollovers from other super funds as well. This is going to become even more problematic for SMSF trustees with this new requirement from 1 October of using SuperStream for rollovers between funds. Because it's all automated, it's going to be linked and be able to review that when this status has been changed, and it's going to be very difficult to roll over monies when the tax returns are not up to date. So in addition to the super fund status change for late lodgement, the ATO has also introduced its 3 strikes and you're out campaign. This is the ATO's communication campaign where a series of 3 letters with escalating warnings will be issued to self-managed super fund trustees with overdue income tax returns. So the ATO is first going to issue the SMSF with a blue letter if they've got an outstanding return, advising the trustees that they are required to take action and lodge the outstanding return as soon as possible. If the ATO doesn't get a response to this first letter, that's strike 1. They're then going to issue an orange letter warning of the potential consequences of not lodging the self-managed fund return. If the ATO still don't get a response to the orange letter, that's considered strike 2. And then finally, strike 3, if we get that far, we'll see the ATO issue a red letter, which is basically a show cause letter instructing the trustees to tell the ATO why they shouldn't put consequences on the fund. So some of these consequences are imposing failure to lodge penalties for all of the overdue years, raising default assessments for each year of non-lodgement, and you can have penalties up to 75% on that, issuing a notice of non-compliance, or disqualifying the trustees of the fund altogether. So they're pretty heavy penalties, and the ATO has said that it's going to be reasonable in their approach to this system. So, for instance, if trustees respond to the issuing of a notice of non-compliance and they quickly lodge all of their overdue returns and they promise that all future returns are going to be lodged on time, then the ATO will likely consider revoking the notice and there'll be no further action. But I think what's really important to take away from all of this, and it's like anything in life, it's going to come down to the importance of communicating in a timely manner with the ATO around issues that are holding up the lodgement of the self-managed funds tax returns. We found in most circumstances that the ATO has been quite understanding and not imposed a lot of these severe penalties. So on that very happy note about late lodgement and ATO penalties, this concludes today's superannuation quarterly update. If you have any questions, my contact details are up on the slide, but I will just wait around for another minute or so that you're welcome to send them through on the chat function as well. But if there are any questions, we'll just give it a minute to send them through. No, perhaps not, perhaps still typing. That's okay. If you do, please don't hesitate to contact me. But thank you for joining me this afternoon. And I hope the rest of your day is just as super.